2018 was a year of highs and lows, the only real winner being volatility. 2018 started with strong synchronous global growth. We finished the year with a much more uneven growth picture. Global equity markets hit their highs in January and have since fallen by more than 10%, with some country indices, such as China, falling by much, much more. As a measure of the weakening trend in global industrial production, the slump in metals prices has been even more intense. Aluminium hit highs since 2011 in April of this year and have since dropped by 28%. Zinc hit highs back to 2007 in February and has since dropped by more than 30%. And nickel was up 60% on a 6-month annualized basis in June. It's down 50% since then in December. Now, crude oil markets have also seen dramatic swings in sentiment. Late in September, many analysts were talking about $100 being possible, only to see prices drop by 30% through October and November. Global bond markets have seen their share of pain too, with US 10-year yields hitting a 7-year high of 3.25% in October, helping the US dollar, which hit a 3.5-year low in February, reverse course to hit 16-month highs in November. This ebb and flow in the US dollar was one factor that dragged the Australian dollar down from 3-year highs above 81 in January to 2-year lows in October, just above 70 cents. However, there were other factors at work too. The aggressive fiscal stimulus applied to the US economy with an already tight labor market saw the Fed raise rates 3 times this year, with another hike coming next week, according to money market pricing. This systematic tightening monetary policy has seen concerns rise that the Fed may end up driving a hard landing, particularly as the yield curve starts to flirt with inversion. Donald Trump executed on his trade war, with steel and aluminium tariffs coming into effect in March, and 2 waves of tariffs on 34 billion of Chinese products at 25% in June and 200 billion in September at 10%. Trade tensions, Brexit, waves of protests in France, budget uncertainty in Italy all played a part in a weakening momentum across other major developed economies, with noticeable growth disappointments in both Europe and Japan. China has also seen a moderation in growth as well, albeit with a slightly better than expected outcome. Geopolitics played a role in the slump in crude prices too, with the US becoming the largest crude producer in the world in August and a net petroleum exporter for the first time since 1949 in November. The pressure on OPEC was rising. The death of journalist Jamal Khashoggi in Saudi embassy in Istanbul in October added to that pressure, and a series of tweets from US President Trump calling for increased production to get prices down the same. So the only real winner in 2018 was volatility. The short equity volatility trade had become an asset class in its own right through 2017. That bubble burst in February this year when the so-called short VIX trade blew up, wiping out close to $3 billion of investor money. 2019 looks like another year of living dangerously for global markets and investors. The tightening in global financial conditions is a big part of this story in our view. Through 2017, the world's central banks pumped a massive $2.5 trillion of liquidity into global markets. In the year to the end of November, they've withdrawn a small amount of liquidity for the first time since 2015. With the ECB set to end its asset purchase program this month and the Fed balance sheet already declining, the shift from quantitative easing to quantitative tightening could certainly add to that volatility too. This is even before we consider that 2019 looks to be one of great uncertainty over the profile for Fed funds rate. The FOMC itself is likely to produce a very scattered dot plot next week, when it's expected to raise rates by 0.25%. The one forecast that Westpac has consistently gotten right in 2018 has been the Australian dollar. We've long forecast a steady decline through the year and 72 by the end of this year, pretty much exactly where it is just now. With the Fed set to continue raising rates next week and beyond, the Australian economy facing the impact of falling house prices and tighter credit, plus the challenge of political uncertainty, we remain confident in our forecast of a further weakening in the Australian dollar to 68 cents by mid-next year. Now, this is our last market update for 2018, and I'd like to take the opportunity to thank all our regular viewers and wish you all the best for the holidays. The new year will start with Brexit in an extreme state of flux, and anybody's guess where it ends up. I'm sure this is a topic we'll be talking about when we return in 2019.